Good afternoon, good evening, and welcome to our presentation on market uncertainty and staying the course. My name is Dexter Cumberbatch, retirement education specialist here with Voya. And this evening, we're going to be discussing this also important topic and ultimately how you can take some of this conversation and continue to plan and get ready for your future for retirement. Now, as a quick disclosure before I fully begin, I am a registered representative of Voya Financial Partners. Over the course of the presentation, I'm not able to provide any tax advice or any investment advice. But if you have any questions, please don't hesitate to ask. In fact, I'll ask myself that if you do have a question, that you use the Q&A feature here on Zoom. And from there, throughout the course of the presentation, that you simply just submit your questions via the Q&A. And then at the end, I will be more than glad to address and answer any questions. Now, in fact, I want to re-emphasize here before I get started that the ABA Retirement Funds Program is here to support you during these uncertain times. The ups and downs of the market can be downright sometimes just stressful. But it is I would say here's where we ought not to panic. We know that market conditions and uncertainty certainly is part of it. As you invest and continue to invest, we know that we're going to continue from time to time to see some volatility. So today we'll discuss a little bit of what's going on in the market and ways to help you get through these uncertain times. And so in this topic, I will be discussing specifically what's happening in your portfolio and the importance of simply staying put. Also coping with the stresses of up and downs in the markets, and some tips to also stay focused, right? And then I'll be touching on some key takeaways here at the end, and then I'll show you how you can receive help. So what's some of the resources that are available so that you can get your questions answered and the assistance that you may need. So with that, I want to start by essentially discussing, okay, what's happening, what's going on, and I'll say that the market can go up and down. Is simply the nature of the game. With that in mind, there's no need to panic. In fact, understanding market cycles is key to getting the most out of your investment goals. Now, it's kind of knowing the course, be it the up and down movements of the market, can help you stay focused and focus on what's important, which are your goals. So here are some of the reasons why the market may go up or may go down. In fact, we know that predicting the future, market changes, it is kind of difficult. But understanding the market cycles certainly gives us a little bit of more resilience, so that we can better be able to make adjustments and certainly make the necessary changes that we may need. So some of the reasons why you may see the market change nor run a supply and demand, and here's where this is when more investors want to buy a stock than sell. This may cause the market to go up, while if more investors want to sell stocks than buy, this may conversely make the market go down. And now, Companies can also, along the way, companies can also report lower than expected earnings. And depending on the earnings, depending on if those earnings are either higher or lower than expectations, that can cause prices to either rise or fall. Another potential factor is rise in interest rates. And I know that we're certainly familiar with rising interest rates. We know that we've been in a rising interest rate environment here for a while, and we all know the impact of interest rates, and last but not least is a bear market, and a bear market is a period marked with falling stock prices. Now, and this is where investor confidence may be low. This is where investors may opt to sell off all their stocks, and this is now again accruing further losses and fueling that vicious cycle of negativity. So these are some of the ways that are some of the reasons why, rather, that stocks and the prices may fall, and you may see a little bit of red in your portfolio, in your statement. But what I would say that what goes down may also come back up. I know that that's not how the laws of physics work, but here, when it comes to the financial markets, it is important to put things into perspective. Now, here on this slide, I want to just show what we can glean from history, and here on this particular page, we can see the performance of different asset classes from a period of, in fact, between 2014 and 2024. And as we can see here, you will have the rate of return of different types of investments, different asset classes, from the best performer on the top to the worst performer on the bottom. And I want you to note that while there's no one color, no one investment performing the best all the time and every single year, we can also see here that diversifying may help mitigate against losses. We can see here where, and this is where this illustrates the importance of just owning different types of investments. We know that not one asset class is going to perform the best every single year, and here's why it's important to essentially own the different types of investments, so that and in fact, this demonstrates the decision of how important it is to make a good decision when you're choosing your investment mix. Now, staying the course is going to be, and in fact, in uncertain times, is going to be really important. So let's talk about the importance of staying the course here, and remembering that each drop in market prices may present a buying opportunity. Here's where you've heard it said, buy low, sell high. Well, this is where, when you see a drop in the value of on stocks, it may represent some opportunities to buy some investments, quote unquote, on sale, to ensure to be able to invest and take advantage of the opportunity of falling prices. Also, it is a good idea to accept market volatility. Here's where we know that volatility will happen. It is part of the process. So one of the ways to help you stay calm and to avoid any emotional responses and knee-jerk responses to market movements is to remember that every market downturn throughout history, market downturns have ended in an upturn, right? All these downturns ultimately have ended with an upswing in the market. And also, when we talk about staying the course and staying put, remember that any decisions that you make, especially early, will have a big impact on your retirement savings. So keep in mind that you don't want to make moment to moment, short term decisions with your investment funds that are and your long term savings that are for retirement and essentially are your long term savings. Now, here I wanted to illustrate, and here we can see that declines are completely normal. And in fact, on this particular slide, we can see the S&P 500. So this is a illustration of the growth of $100, and this includes dividend reinvestment of $100 in the S&P 500 from 1974 all the way to 2024. And as we can see, there are a few downturns here, but overall, we can see that the investments would have grown throughout different decades, even and throughout different market conditions and different time periods. Now, you may have heard the term a market correction. Well, and simply put, it's a drop of at least 10% of any security or market index following a temporary upswing in the market. So sometimes we can see a correction. I'll say every couple of years or so, every 4 years, we can see a little bit of a correction. There have been approximately 38 market corrections since 1950. This is good to know because when stock markets goes down, again, many people panic and sell their shares rather than being patient and waiting things out. Also, again, when we do have a correction, it's always a good opportunity to be able to essentially buy low and actually invest more. Now, how can we cope? And let's get into ways that we can cope with the stresses of up and downs in the market. For starters, we know when we see the market going up and down, it can be a little bit stressful. And it is important to understand that while the market performance may be volatile, there are steps we can take to cope with these feelings before we make any type of rush decisions with our investments. So one of the ways is to understand the 14 emotional stages an investor goes through. We'll dive deeper into that one on the next slide. But also I'd say while there may be volatility in the stock market, what goes up may come down, but then again it may go back up. So don't let this day-to-day market volatility cause significant stress and essentially make certain important decisions based on any day-to-day movement. Also, as you continue to invest, consider your financial wellness. While there may be volatility in the market, your investments are a piece of your larger financial wellness journey. And this is why it's important. It's really important to stay focused on your long-term goals and certainly consider other aspects of your financial wellness before you make any harsh decisions. Now, and this is where I take the opportunity to also again say to think about your long-term goals. We know that it may be a little bit tough. It may be a little bit hard especially in a moment, to think about yourself 20 or 30 years from now to actually think about retirement. But staying the course and sticking to the plan can be the best thing that you can do for your future self and for your retirement. Now, I talked about the 14 emotional stages of an investor. So here and this chart depicts this emotional roller coaster that can come along when essentially prices are falling and the market is falling, and then again rising. So starting from left to right here, we can see that when the economy is up, there can be a lot of optimism, a lot of excitement when your investments are growing. It feels great. I know because I've been there, and to the point where at the peak, and quite frankly, sometimes we don't know when that peak is. We can feel euphoria. We're thinking, you know what, this works great. Let me continue to invest. This works. But then along the way, as we see adjustments, as we see prices start to adjust, or maybe go in the other direction, we can essentially experience a little bit of anxiety, maybe a little bit of denial, even fear, even. And then if we see a continued period of falling prices, we can go to downright panic and even capitulation. Now that at that point and at the bottom, which is hard to predict, is no one knows essentially when the bottom. This is when a lot of people may make mistakes, right? Meaning they may sell off all their investments. They may just surrender and say, you know what, this doesn't work. Indeed, I'll say solidifying their losses. But then, normally at that point is when we start to see a little bit of relief, and it's that period of recovery where the market starts to go back up again, and then the cycle again resumes and then continues. So I will encourage everyone to again keep this in mind, and certainly when you are making investment decisions, make sure that you're making decisions, good decisions. You're making the decisions, and if you need assistance, if you need perhaps the expertise of an advisor, if you need to review your financial plan, your investment plan, your goals. It is always a good idea to do so before you make any drastic adjustments to your investments. Now, keeping a cool head, it can be sometimes difficult. Now, as I mentioned, keeping and having a game plan also includes tracking your investments, tracking your investment composition, your portfolio composition, essentially, fully well knowing that when it comes to investing, we know that everything is relative. It is important that you do your homework. In fact, you don't have to do it all yourself. When you have questions, this is a good way to essentially are a good opportunity to consult a financial planner, and then continue to save as you invest. It is always important to stay the course and continue to save, and having some emergency savings is going to be also important. Make sure that you invest money that invest what you can afford, and you have some emergency savings so that if you should anything arise, you don't have to tap into your investments, but instead you have some savings available. And then again, having a roadmap is going to be important in order to stay focused and continue to be able to save and weather any market conditions and any volatility. So here are some more tips on staying focused. As a quick reminder, one way to avoid worrying about the stock market is to only invest, again, money that you can afford. And also you want to avoid stops and starts, meaning you want to avoid stopping your contributions. So if you are contributing in a retirement savings plan, if you are systematically contributing every paycheck or every month, every time period, you want to avoid stopping and starting when you continue to invest, and when you invest regularly, you do take advantage. You can also take advantage of that volatility by investing by dollar cost averaging, and I'll talk a little bit more about dollar cost averaging here in a moment. And again, and here's where it is going to be important to not lose sight of your long-term investment objectives. So here are some strategies and where you can go from here. Number one, avoid timing the market. Also knowing that asset allocation is going to be really, really important. And then diversifying. Diversification is certainly a key. And then again, dollar cost averaging into your investment plan, and then from there knowing your risk tolerance and determining your true risk tolerance. So here on this particular slide, I wanted to show the importance of not timing the market. In fact, time investing and your investment mix is going to be a big factor in actually being successfully investing. And here on this slide, it does illustrate the return of a $10,000 investment invested in the S&P from 2005 to 2024. And we can see that someone that remained fully invested for the entire period would have averaged about 10.4%. So total return of 10.4%. So in other words, they would have seen a growth of from 10,000 to 71,700, and this is in comparison to someone that would have missed the 10 best days, where that return would have dropped to 6.1%. And then if you would have missed the 20 best days because you would have timed the market, we can see how the rate of return would have fallen. And this is all the way, and even more had they missed the 40 or 50 best days. So this is one of the reasons why, again, it's going to be important to not time the market, but in fact instead remain invested, so that you can successfully invest. Since we don't have a crystal ball, we are not certain of when the market will go up, when it will go down. And also, it is going to be important to not put all your eggs in one basket. Asset allocation is certainly key. Your investment mix is key. And there are going to be plenty of opportunities to diversify your investments. When we talk about investments, there is certainly the opportunity to invest in equities along with fixed income or bonds, and then cash investments. In fact, in the ABA retirement funds program, you will notice that there are going to be many different funds. These funds are in fact, you will see some stock funds along with some bond funds and some cash investments. The equity funds in your plan are going to be further diversified into companies and stocks from different companies across different industries, even in across different countries or different parts of the globe. And then you're going to have some bonds where these bond funds have different issuers, and there is a cash investment. This is so that you can build a good investment mix. And so how you spread your money within each of these asset classes is called, again, diversification. And it is a good risk management technique that mixes a wide variety of investment options within your portfolio. Now, I mentioned earlier dollar cost averaging, and this is where you can invest through dollar cost averaging. If you are investing in your retirement savings plan, and you're investing consistently, they're contributing to your retirement account, you are dollar cost averaging, and you can easily do so through your payroll deductions in the plan. And this strategy, I'll say that this is where you invest consistently, a consistent amount through a long period of time. And what happens here is that the average market price, or in fact, what you end up paying, the average cost per unit is a little bit lower than the average market price. So in other words, and in this example, you can see that someone that would have invested perhaps in January through June with a total investment of $600, they would have purchased about 88 units with an average market price of $7.17, but a lower average cost per unit of $6.79. And this is because, again, using that dollar cost averaging, we know that the price per share that they would have paid every month because of volatility would have been a little bit different. So essentially bringing the average a little bit lower. And then now let's talk about risks. And there are all kinds of risks when it comes to investing. We know that they are going to be different funds in your plan. And in fact, when we talk about risks, in short, we are talking about your comfort level towards risk, because this is going to impact how you feel and the investments that you choose. On this continuum here, on this particular chart, we see how different types of investments they are on different parts of this continuum. Some funds are going to be a little bit higher risk than others, but at the same time they have the potential for higher returns. And so the rule of thumb here is that the greater the potential risk, the greater the potential reward. So you should always consider your personal risk tolerance when making these investment-related decisions. In fact, there is a risk tolerance questionnaire on the ABA Retirement Funds Program website where you can answer about 8 questions. It's a short risk tolerance questionnaire, and the result is that you receive you get to know your investor profile, your risk tolerance, and also it would provide you with a suggested investment mix based on that risk tolerance, based on the questions, based on the answers to the questions. So here are some key takeaways. So let's recap what we've discussed so that you can have some clear takeaways to leave with. Number one is, we mentioned risk, and many people automatically think, well, when we talk about risk, we only mean investment risk, which is the concern that there will be a market downturn that will erode our investments and our gains. But also, I would say that there are other kinds of risk here. Some of them are a little bit more obvious than others. But I want to leave you with this. Yes, stocks are risky, but so is avoiding investing in them. So at the end of the day, as you continue to invest in your plan, certainly you want to remind yourself of why you started investing in the first place. So if you're in it for the long run, then it is a good idea to embrace uncertainty and keeping in mind that you do have a long-term plan in place. And then market volatility can also be used to your advantage because you can certainly buy low when the market is low. So history says stay invested. You heard the term that says stay the course. You heard people say, well, you know what, stay the course, stay invested. And I say that historically, those who have stayed invested and long-term investors have outperformed other types of investors. So certainly you want to consider staying invested and staying focused. Now you will see that if you are a little bit younger, and some of you may be early in your career, while others you may be mid-career, or even some of you may be approaching retirement within, I'll say, 15 to 5 years away from retirement. If you're a little bit younger, you may want to consider if you experience a downturn, you want to consider simply doing nothing. Right? This is when you're just starting to invest. So if the market is low, if there is a downturn, you want to make sure that you continue, or you start investing so that you can start buying lower before prices become higher. Now, if you are kind of near the middle here, you're closing in on the middle of your career, then you may want to be a little more proactive. You may want to consider, I'll say, diversifying. You certainly will want to take a second look at your investments, on your investment mix, to ensure that you're investing in the appropriate investments, that you have the right investment mix. And certainly you want to stick to the plan. And if you are perhaps near to retirement, well, this is the toughest spot to be in during a market sell-off, since you are concerned about retirement. It's right around the corner. But this doesn't mean that a downturn has to spell disaster. One of the best means of winning back lost ground, if you experience a downturn just before you retire, is to find ways to boost your income and have those go into your retirement savings. Certainly, here's where I'll say, if you're close to retirement, number one, you want to make sure that you review your investments, and especially if you haven't yet spoken to an advisor. This also is a good opportunity to actually speak with an advisor, so that you can essentially ensure that you're on the right track. Now, there's going to be plenty of help available in the plan. In fact, as part of your ABA retirement funds program, I will say that there is that investment management. We do offer advice. And on one hand, there is online advice, which you can find on the plan website. With online advice, you do get that savings and investment advice, but you still are able to essentially choose your own investment mix. It is designed for folks who want advice, but at the same time wants to be able to invest at their own investment mix. But also then there is the full professional management. This is offered through Voya Retirement Advisors. It is on the plan website, where you can not only receive advice, but also you can receive professional management. And with professional management, what happens is that we certainly do the work. We provide that savings and investment advice, and then we from there will actually execute and manage the investments for you. So I would say that you want to consider online advice if you feel confident making your own investment decisions, and you're willing to take the time to monitor and make ongoing adjustments to your plan yourself. Now, if you need help, especially help getting on track and staying there, then you may want to consider that professional management, where you don't have to research your investments, and keep up with your account, but instead you want a team of professionals to manage your account and your investments. In addition to monitoring your retirement account and investments, it is also important to engage in a holistic retirement in holistic retirement planning. And this is where you are able to partner with a Voya financial advisor for that. So together with a Voya financial advisor, you can go through 5 steps to build your retirement income plan. And number one as well, to discuss your vision and your goals for retirement. And then from there, start pulling your financial picture together and then explore and begin to develop that plan, a plan to achieve your goals, including that big picture balance sheet and spending versus income sources in retirement. And then from there, you can just with your advisor will show you your different saving scenarios, based on different goals and income options in an effort to improve your outcome and help you reach that goal. And then from there, you can choose the best plan that suits your needs. And then there will be those regular reviews with your advisor, at least annually, to keep everything on track. And then identify any trigger events, or if there's any changes that needs to be done that may affect your goals in retirement. So here's where Voya offers 2 ways to get that holistic retirement income advice. With the retirement income advice, we can do a retirement snapshot, which is available at no additional cost. So it is designed for folks with a relatively simple financial situation who want to get answers, for example, answers to questions like, am I on track for my retirement goals? So how much income will my savings generate each month, right? Or even if you're wondering, okay, how long can I expect my savings to last? Here's where you can certainly get answers to those kind of questions. You'll meet one-on-one with a Voya financial professional who will analyze your current financial situation and then provide a personalized action plan with easy to follow next steps. Now, we also have the financial plan, which is a fees-based service designed for those with more complex financial situations. So this is where we address certain strategies for various goals, including retirement income, estate planning, and life insurance, and then from there, we help you prioritize your actions to reach those goals. And if you're interested, here is how to essentially connect with a Voya financial advisor. You can certainly either scan this QR code, or you can give us a call. And from there, we can schedule a complimentary one-on-one session so that you can discuss and get started, discuss your goals, and certainly get started. Now, to access your account in the ABA Retirement Funds Program, you are able to either go to the abaretirement.com plan website. You can also access your account on the go by downloading the Voya app. And you can download the Voya app, regardless of whether you have an Android device or Apple device. You can find it in your app store. It is an easy way to access your account. If you have Touch ID, depending on your device, if there's Touch ID, Face ID, you can easily log into your retirement account. And then and you can always call us. You can always call us between 8 a.m. and 8 p.m. Eastern time, Monday through Friday, if you prefer to speak with a customer service associate who can assess and help you make changes to your contributions and your investments. Once again, thank you so much for joining this session. This will be the end of our meeting today. Take care, everybody. Have a great rest of your week. Thank you.